Most traders don't fail because their strategy doesn't work. They fail because they don't stick with it long enough to see it work. One of the biggest mistakes in trading is changing your strategy immediately after a loss. A single losing trade feels personal. It feels like proof that something is broken. Your confidence drops, fear rises, and suddenly the system you trusted yesterday feels useless today. So you jump to a new indicator, a new setup, a new YouTube strategy, or a new 100% win rate method. But what you are really doing is running away from short-term pain. Losses are not a sign that your strategy is bad. Losses are part of the statistical structure of trading. Even the best strategies in the world have losing streaks. Professional traders understand this. They measure performance over 50 trades, 100 trades, sometimes even more, not over one emotional moment. When you change your strategy after every loss, you never give any method enough time to play out its edge. You stay stuck in a cycle of constant switching, constant doubt, and constant inconsistency. There is something called recency bias. It means your brain gives more importance to the most recent result. If the last trade was a loss, your mind starts believing the whole system is flawed. But trading is a probabilities game, not a prediction game. A coin can land on heads 5 times in a row, but that doesn't mean the coin is broken. In the same way, a good strategy can lose 5 trades in a row and still be profitable over time. Another problem is emotional attachment to being right. Many traders cannot emotionally handle being wrong, even temporarily, so they try to escape that discomfort by changing strategies. It gives a false sense of control. It feels productive. It feels like action. But in reality, it is emotional decision-making disguised as improvement. Real improvement comes from data, journaling, reviewing trades, and identifying whether losses came from the strategy itself or from breaking your own rules. If you truly want consistency, you must define clear rules before entering the market. Define your risk per trade. Define your entry conditions. Define your exit plan. Then commit to executing at least 30 to 50 trades exactly according to plan before evaluating results. During this period, do not modify your system because of emotions. Only change it if your data proves there is a structural flaw. There is a huge difference between a strategy that has normal drawdown and a strategy that has no edge. Discipline is what separates amateurs from professionals. Professionals expect losses. They prepare for them. They calculate position size in a way that a losing streak does not destroy their account or their mindset. They understand that the goal is not to avoid losses. The goal is to manage them. Once you accept that losses are tuition fees in the business of trading, you stop reacting impulsively. So the next time you face a losing trade, pause. Do not rush to change everything. Ask yourself, did I follow my rules? Was this loss within my risk plan? Is this statistically normal? If the answer is yes, then your job is simple. Continue executing. Consistency in execution creates consistency in results. Strategy hopping creates confusion. In trading, your edge is not just your system. Your real edge is your patience. Stick to your plan long enough to let probabilities work in your favor. Because the market does not reward those who react emotionally to one loss. It rewards those who stay disciplined through many.